Hello traders, Gary Wagner here. Just about 1 o'clock in Honolulu, 6 o'clock in New York on Friday. Happy Aloha Friday, as we say on the islands. It is November the 12th, 2021, and this is the daily report for gold and silver. November has certainly been a pivotal month, beginning with a much more dovish rhetoric coming out of the Federal Reserve, then a report from the government indicating inflation is spiraling out of control, 6.2% according to the CPI. Those are numbers not seen since 1990, and the subsequent reaction to gold. Those are the topics we will explore in our opening letter and our show in terms of technical analysis. November has proved to be an extremely key and critical pivot point for price changes in gold. Beginning on November the 3rd, the FOMC meeting concluded, and in fact, gold closed lower on the day, trading to a low of about $1,760. It was absolutely a delayed reaction because concurrently we had the Bank of England and the European Central Bank coming out with the same thinking they would leave interest rates intact. The Fed announced tapering. However, I believe that was largely factored into current pricing. What we saw on the following day, or Thursday, was a double-digit rise, followed by Friday's double-digit rise, taking gold to an intraday high of approximately $1,820 and then closing at right around $1,816. That takes us to the activity this week. On Monday and Tuesday, we had modest, almost fractional gains in the market, and that was up until Wednesday when the CPI inflationary index came out in a report by the government showing that the current rate was 6.2%, an inflationary level not seen since November of 1990. That took gold to an extreme high, actually breaking above 1867, but closing well below that at approximately 1848. We had a dramatic rise yesterday, which contained a higher low, but not a higher high. And today we had a higher high, a higher low, and a higher close, with December futures currently at $1,867.10, a net gain of $3.20 on the day. One of the things that occurred this week as gold began to move up, specifically on Wednesday, was that we had the dollar moving up tremendously, with gold also moving up about the same, a percentage gain in each of them. Yesterday, we also had a sizable rise in the dollar, and that was followed by a significant rise in gold. Today, we did see some weakness in the U.S. dollar, giving up fractionally 0.05%, but it's currently fixed at 95.125. That is a level we have not seen since last year. We did issue a buy signal for both gold futures as well as cash or Forex gold, but prior to that, we did enter a trade in the Spider Gold Trust, or GLD, about a week before at approximately 168. Today, we gained 33 cents per share in GLD, and the current price is $174.45. December silver futures closed up by about 10 cents, or 0.4%. It is currently fixed at $25.40. Our daily subscribers know that we recommended entering long positions once silver breached a key and critical number, which occurs at 24.27. Those subscribers are still long December silver futures. We'll talk about all of our trades as well as our stop when we pull up our charts. The first chart we are looking at is a daily candlestick chart of December futures. It contains our former forecast that we created prior to the announcement that the CPI had risen to 6.2%. We had anticipated that what we would see is gold breach $1,835 by the end of the year. Obviously, that price point has been breached at a much sooner point than we anticipated. The other forecast that we had derived from our technical studies is that by the first quarter of 2022, we would challenge $1,900 per ounce and go as high as 1920, which is the highs that came in June of that year. Now, as I said, we've reached our first goal, and we have updated our interim term forecast, which I'll put up right now. And what you're looking at is our current forecast. Now that we've taken out this key and critical resistance area, I now believe this to be an area of support between 1827 and 1835. I believe our current resistance level comes in at 1866.50. Of course, we closed at 1867.70, so just above that. But this still is a point of contention because we didn't see an effective break above that. But I believe that one of the best scenarios we could see would be for the market to trade sideways and not have any kind of sizable correction, rather than looking at it to continue to rise with the same momentum that it did over the last 7 trading days. But our major change in terms of our interim forecast is we are now forecasting that gold will challenge 1900 and possibly breach the high seen in June of 1920 by the end of the year. While that sounded far-fetched 3 or 4 months ago, at $1,867, we are about $33 shy of challenging $1,900 per ounce. On today's show, I not only wanted to update where we believe gold will go to this year, but give you my first forecast of 2022. And we began to discuss that yesterday. And to do that, we need to pull up our weekly charts in which we've created studies combining Fibonacci and Elliott wave theory. In light of the recent reports indicating such a spiraling and out of control level of inflation that the Federal Reserve and the administration currently are adamant about saying is temporary, it is our belief that it will be much more persistent than they are willing to admit or acknowledge. The techniques that we're using to create this forecast for a long-term study like a 2022 forecast requires that we use weekly charts. And what we are doing is basically looking at an Elliott wave count. We're looking at this third wave, which was the largest upside wave, moving gold from 1452 in March of 2020, when the epidemic became a pandemic, and then looking at the subsequent retracement that took approximately from August to March of 2021, when we hit these lows at around 1672. From there, we can do a fib extension by measuring the distance between the low and the high of our third wave and the beginning and extension from these lows at 1672. Typically, we would see a wave 5 be a 0.618% extension of the distance moved in wave 3. However, in commodities, a lot of times you get an extended fifth wave and it goes much higher than a 0.618% extension. So I've marked in the other areas that we could look at. The first one is a 78% extension, and that would take gold to about 2165. And our highest forecast comes in just under a 1-to-1 relation. And this, of course, is based upon the assumption that inflation will continue to be persistent and at these levels that have not been seen in 31 years. It is also based upon the assumption that the Federal Reserve has backed themselves into a corner and cannot easily begin to raise rates, and if they do it in small incremental amounts, possibly with one rate hike towards the end of the calendar year 2022. Meaning, inflation will continue to run hot. In lieu of getting to maximum employment, we have a great labor shortage in the United States, and that is the problem they are trying to resolve before addressing the overheating of inflation. For the reasons we have just spoken about, I believe that 2060 to 2165 are highly achievable, and of course, 2165 would be close to the all-time record high, and 22 to 2300, which is our upper level projection, would take gold to an all-time record high. And I think that that is a realistic expectation under the criteria and assumptions that we just spoke about. The last thing that I do want to address is the recent spurt or climb in the US dollar index. You can see that on this weekly chart, gaining almost a full or just over a full percentage point in terms of its value. When we look at it in a historical basis, meaning going back to 217, when it was sitting at just shy of 103, to breaking that at 103.90, which occurred really, again, in March of 2020, when the pandemic really started to rear its ugly head. From there, we saw almost a straight decline in dollar value, and it was a multi-month decline from March up until the first bottom that occurred at the beginning of 2021, and then the second bottom that occurred in approximately May of 2021. From there, we saw the dollar index move from just under 90 to roughly 95, a 5% increase. I believe that if inflationary pressures continue to mount, the go-to inflationary hedge or asset is going to be gold and not the dollar. The dollar has been rising under the anticipation of rising yields in U.S. debt instruments. My sense is it will not keep up with the inflationary pressures that continue to mount.
This has been Gary Wagner wishing you, as always, good trading. We will talk to you on Monday for the next daily update and review. Bye-bye.